everyone, this is Dimo Gonzalez of Heartwood Financial Services. Thank you for joining us for our latest market update and outlook. In these videos, I always want to bring up relevant and important information without all the hype and without all the spin that you hear normally in the media. So today's topic is waiting is the hardest part. Yes, it is a Tom Petty song. I love that song. And so you're going to have to wait till towards the end of the video to really find what it's about. But you'll see it's all going to make sense. So let's get right into it. All right, well, we finished the half in quite a bang, like 4th of July. And you can see the green is all the year-to-date numbers, and they look pretty good. Large cap, small cap even kind of came back. Developed international and bonds all did pretty good for the first half of 2023. And a lot of people would have not guessed that this was going to happen. And it finished off with a very strong June. And what I'll point out here, which is a little bit of a change from so far this year, it's small cap and real estate that really led the last month of the half. And you also see a little bit of a surge in commodities as well. So this is an interesting change, and it's actually a very positive development. That means that the market is broadening out a little bit. It's not just a few of the big names in the large cap stocks. So let's get into a little bit more about what's been going on. All right, as all of my market updates for the last year or so, I've been starting with what's going on with inflation. And we haven't had a new reading since last month. We will have one next week, actually. But the latest one we got was with the CPI at 4% versus the core CPI at 5.3. And I want to dig into this a little bit more. I want you to understand what's going on. This was a nice little graphic. As you can see here, all these different items include what's in the basket of goods for the CPI index. And that overall, what they call headline inflation number, has been going down, okay? And a lot of it is because of energy, a little bit is because of food, but it's mostly because of energy and transportation, electronics, some of these other things. What's been really sticky has been housing, okay? And so the Fed has been looking at what they call core inflation. Doesn't include everything. It just includes these categories here. And housing is a really big component of that, over 40%. And so basically what happens to housing is what's going to impact core inflation the most. And it has been sticky, and it's getting the Fed to kind of stick to their guns about continuing to keep interest rates high and maybe even continue to raise them even more. All right, next I want to talk about the inverted yield curve. Now you probably heard me bring this up in the past several times and how it could be an omen for a recession. But what I haven't really done in the past is show you a chart that shows the historical patterns of what's happened when there is an inverted yield curve. And as you can see by this chart, this shows anytime the 10-year minus the federal funds rate, which right now is at 5 to 5.25, and the 10-year is at around 4. So it's upside down. It's a negative yield curve, which is why you see this blue line below the zero. Every time that happens in the past, there's these gray bars that show an inflation. All right? Inverted yield curve, inflation, every single time. Okay? Would it be different this time? Probably not. There's a lot of dynamics of why this happens, why the yield curve gets inverted. But it's because of things that are happening to the economy that are not good. Okay? And we're actually in a pretty deeply inverted yield curve that we haven't seen since the 1980s, back in the last time there was a lot of inflation, which is actually what this little chart was talking about. When there's a lot of inflation, inverted yield curves are deeper than when there's deflation. So that's not completely unusual that it's very inverted right now. But it's hard to imagine the market completely avoiding, or the economy, I should say, completely avoiding a recession. Now, that doesn't mean it has to be deep and really powerful. It could be shallow and hopefully not too long. That's hard to know, but it does seem imminent. All right, so here is the market outlook. So far, what I put together in the video is, again, kind of grim. We got a sticky inflation, which means the Fed's going to continue to be hawkish. They're not going to let off the brakes anytime soon. Yes, that's a possibility. We also have this inverted yield curve. Doesn't look good. Almost always recession. Okay, but the challenging thing here that I want to at least entertain is that the Fed is driving the economy looking through the rear view mirror, or in this case the side mirror. And so they're talking hawkish because they're looking at data that's kind of old. I think they know this, because if I know this, they got to know this too. But they just don't want to make it super obvious because they don't want people to let up and things to loosen up too much. They have to contain inflation as best as they can. So I want to present some ideas that will make you think that maybe the Fed will let up a little quicker than maybe the current rhetoric is expressing, and how things could maybe change pretty quickly because of that. So let's get right into it. So here is a chart of shelter costs and how they are lagging big time. Okay, so here is the orange. This is the CPI shelter component year over year. You can see it's up 8% year over year, and how it's been steadily going up, and it's starting to finally crack and start to go down a little bit. The pink line here is the line where the actual hard data of rents and how they spiked in 2021 during COVID and early 2022. And basically since early 2022, it's been coming down hard. I mean, this is quite a slope downwards to where we're only up 0.9% year over year on rents, which is how they calculate that shelter cost. So what do you think is going to happen to this orange line? Okay, I think it's going to come down pretty quickly. It's just a lag. So this is what I mean by the Fed is driving the economy, looking through the rearview mirror. They got to know that this is coming, but they're still talking tough. Again, they don't want to let up too early, but as you can see, they're going to be able to. And in fact, because of all the reasons I explained last month, they're going to want to. So this, again, could actually be a pretty positive note for the markets. All right, I also wanted to give you a little bit more color, literally here with this chart, about the yield curve inversion. This is a similar chart to what I showed you in the update, but JP Morgan put together this slide to show the average length of time that it took from an inversion to a recession. I know this is getting a little nerdy, but this is pretty important to see, because you can see the average amount of time that it takes is about a year. And the last time we had an inversion was October of 2022. So it hasn't been quite a year yet. We're getting pretty close. And I actually think that we're probably going to have one of those recessions that comes even later, because there's so much pent-up demand, especially for services, and there's still a lot of money in consumers' pockets. So I think we're going to probably come closer to that longer time to recession scenario. And again, it may not even be that severe, but it does look like it's on the horizon. All right, so here's the final slide, the Hartwood implications. This is when it comes down to, what does this all mean, Demel, that you've been talking about? And how are you going to tie in the title, the waiting is the hardest part? Well, you know, last month when I put together the Hartwood implications, I said I was waiting for some of the smaller cap stocks, the international and real estate kind of stocks, to start bleeding and start to actually perform better. And guess what? That's exactly what happened last month. And there are some signs that maybe the market's kind of already priced in the mild recession that is being anticipated. Okay, I am not quite ready to call the all clear and the green light like we have in this slide. So that's why I'm naming this whole video "Waiting is the hardest part," because I'm not quite convinced. I want to see a little bit more evidence, either inflation coming down quicker because of that shelter cost component that I talked about, or a continued breadth in the stock market of those small caps and those real estate and the international stocks doing better. For now, we're going to stick to a pretty neutral overall exposure to stocks versus bonds. We're mostly going to hold in a holding pattern. If anything, I am adding a little bit more to bonds opportunistically as interest rates kind of creep up a little bit in anticipation of the economy actually maybe not being so bad. But I do think that things will get maybe a little bit worse, so I think the bonds will be a good buy in this range. So I'm continuing to move a little bit out of cash, a little bit more into bonds, but I'm getting very close to getting to the point where I might start adding a little bit more to small cap and international, but not quite yet. We're gonna keep being patient and wait, just like Tom Petty says. Thanks, guys. I hope you guys enjoyed the video, and God bless. Bye-bye.